There's a woman named Karen, 44 years old, an office manager in Columbus, Ohio. She's been doing everything right. Or so she thought. For the last 11 years, she has deposited a portion of every paycheck into the same savings account she opened in 2013, the same Chase branch on West Broad Street, same account number, same little book she used to balance manually before the app took over. She has $22,000 sitting in there right now. And last year, that money earned her $2.20 in interest. Not $220, not $22, $2.20, less than a gallon of milk. Then there's David, 41, an IT project manager in Austin, Texas. David is not a finance guy. He doesn't track markets. He doesn't have a broker. 3 years ago, someone at a barbecue mentioned Marcus by Goldman Sachs. He spent 20 minutes on his phone that Sunday afternoon, transferred his $22,000 emergency fund, and went back to his burger. Last year, that same $22,000 earned him over $800 in interest. While he did absolutely nothing, Karen didn't make a mistake. She made the same choice most Americans make. She stayed loyal to a system that stopped being loyal to her a long time ago. If you're someone who still has most of your savings parked at a big brick-and-mortar bank and can't figure out why your money never seems to grow, subscribe and like this video. It will help more than you think. Here's what most people get wrong about this. They think the problem with traditional savings accounts is that the rates are a little low. That's not the problem. The problem is that the rates are designed to be invisible, low enough that you never notice, but not low enough to make you angry enough to leave. Think of it like a treadmill set to the slowest possible speed. You're technically moving, you're technically saving, but you're losing ground to inflation every single month, and the machine is counting on the fact that you're too busy to look down at the display. The national average savings account rate at a traditional bank right now, in April 2026, is 0.39% APY, according to FDIC data. Inflation is running around 2.7%. That gap, the distance between what your savings earns and what your purchasing power loses, is the silent tax that traditional banks have been collecting from ordinary Americans for decades. Goldman Sachs understood this when they launched Marcus back in 2016, not as an act of charity, as a competitive weapon. They knew that most Americans were parked in accounts that paid them almost nothing, and that a simple fee-free online account with a dramatically better rate would pull deposits fast. They were right. And whether you use Marcus specifically or any of the high-yield options now available, the insight they proved still holds. The traditional savings account, as most Americans use it, is no longer a savings tool. It's a storage unit with a leaky roof. Here is where the real math lives, and I want you to sit with it for a moment. Karen's $22,000 is sitting in a Chase savings account, earning 0.01% APY, the standard rate for one of the largest banks in the country. Bank of America and U.S. Bank offer the same. Over 1 year, that money earns $2.20. That's not a typo. $2.20 on $22,000. That's less than the tip she'd leave on a $15 breakfast. Now put that same $22,000 into a high-yield savings account, earning 4% APY, a rate that multiple online banks were offering as recently as this week. After 1 year, she earns $880 on exactly the same money, with exactly the same risk, because both accounts are FDIC-insured up to $250,000. That difference, $880 versus $2.20, is not a footnote. That's $877 that Karen is leaving on the table every single year. Over 5 years, compounding even conservatively, that gap stretches past $4,500. That's a car repair, a semester of community college for her kid, or 4 months of groceries for a family of 3. And here's the thing that makes it particularly frustrating. The high-yield options are not exotic. They don't require a financial advisor, a minimum deposit of $10,000, or a degree in economics. Marcus, Ally, VO Bank, Axos, these are standard federally insured savings accounts. You open them on your phone in about 10 minutes. You move money in and out like any other account. The only thing different is the number they put next to the percent sign. David, our IT manager from Austin, figured this out at a barbecue. He wasn't researching investment strategies. He was half paying attention to a conversation and caught the name of a bank he'd never heard of. 20 minutes later, his emergency fund was working 10 times harder than it had been the day before. The reason Karen's money is still earning $2.20 a year isn't stupidity. It's inertia. Inertia is the single most powerful force in personal finance. The account is already open. The paycheck already goes there. The app is already downloaded. Switching feels like work, and the cost of not switching is invisible. Because $2.20 is so small that your eye skips right over it on the statement. That's what traditional banks have banked on for 30 years. Literally. Here's where it gets uncomfortable. The Fed raised interest rates aggressively starting in 2022 to fight inflation. 11 rate hikes over roughly 18 months. When rates went up, something interesting happened. Online banks passed those higher rates directly to customers. Marcus went from sub 1% to over 4% APY within a couple of years. Ally followed. A dozen others too. The big brick-and-mortar banks? Chase savings went from 0.01% to 0.01%. Bank of America, same. They absorbed the rate environment and kept almost all of it. Think about that. The Fed raised rates 10 times. Your Chase savings account rate didn't move, not a basis point. The Fed has since cut rates 3 times in late 2025. And now, as rates ease, the same traditional banks will use that as justification for why savings rates can't be higher. They'll reference the Fed. They'll reference their operating costs. What they won't reference is the 30-year window during which they offered 0.01%, even when the federal funds rate was above 5%. This is the turning point that Karen is living inside of, without knowing it. It's not that she's bad with money. It's that she's playing a game where the rules were written by the other team, and nobody handed her the rule book. The psychological trap here has a name: loyalty inertia. It's the assumption that the institution you've been with for 11 years has your best interest at heart. Sometimes it does. In the case of your savings rate, the data says otherwise. So, what does moving forward actually look like? 3 things, not complicated, just specific. The first is to check your current rate today, not tomorrow, today. Log into your savings account and find the APY line. If it says anything below 1%, you now know what that means in real dollars. Take Karen's math and apply it to your own balance. Calculate what you're actually earning versus what you could be earning. Write down the number. Make it real. The second is to open one high-yield savings account this week. Pick one: Marcus, Ally, Viobank, Axos, any FDIC-insured option with a rate above 4%. The account will ask for your name, social security number, and a linked bank account to transfer from. It takes about 10 minutes. You don't have to move everything immediately. And David moved his emergency fund first, the money he was least likely to need on a Tuesday afternoon, and left his checking where it was. That's a perfectly reasonable way to start. The third is to automate. Once the account is open, set up a recurring transfer from your paycheck or checking account into the high-yield account each month. Even $200 a month compounds meaningfully over time. The goal isn't to become a savings maximalist. The goal is to stop silently subsidizing your bank's profit margin with money that was supposed to be building your future. I've had my own savings in an online high-yield account for years now. The difference in interest earned over that period isn't life-changing on its own, but it is real money. Money I did nothing to earn except spend 20 minutes making a different choice. That's the math that Goldman Sachs saw coming in 2016 when they built Marcus. Not complex investing, not market timing. Just the simple arbitrage between what the big banks refused to offer and what customers actually deserved. Karen is still using that account on West Broad Street. As of today, she's earned another fraction of a penny. That's not a knock on Karen. Karen represents something most of us recognize. The version of ourselves that is busy, trusting, and a little too comfortable with the familiar. The part that assumes the bank has already done the math and that everything is probably fine. Goldman Sachs didn't launch Marcus because they cared about the American saver. They launched it because they saw an enormous gap between what banks were offering and what people deserved. and they built a product to exploit that gap before someone else did. And that's capitalism working exactly as advertised. And the strange, slightly ironic outcome is that an investment bank for billionaires ended up building one of the most accessible savings tools available to ordinary Americans. The traditional savings account isn't disappearing overnight, but as a place where your money grows, it has already been dead for years. Most people just haven't checked the pulse. Your emergency fund, your short-term savings, the money you're parking. For a house or a car or a cushion, that money deserves better than $2.20 a year. The tools to do better are free, federally insured, and available on your phone right now. Tell me in the comments, what's your current savings account, APY? If you're sitting below 1%, this is the week to change that. And if this video made something click, like and subscribe. There's more where this came from.